Understanding open-end management companies. Investing in financial markets can be a daunting task, especially for those new to the world of investing. Fortunately, open-end management companies play a critical role in making investing more accessible. This article delves into what an open-end management company is, how it operates, the types of funds it manages, and the distinctions between various investment vehicles. What is an open-end management company? An open-end management company is a type of investment company that manages open-end funds, primarily focusing on open-end mutual funds and exchange-traded funds, ETFs. These companies are structured to harness capital from multiple investors, allowing them to pool their investments and benefit from economies of scale in management. Key characteristics. 1. Open-ended structure. Unlike closed-end funds, open-end funds do not have a limited number of shares. An open-end management company can issue new shares as long as there is demand from investors. Conversely, closed-end funds have a fixed number of shares determined at the fund's inception. 2. NAV pricing. Open-end funds are bought and sold at their net asset value, NAV, which is calculated only once a day after the markets close. This methodology ensures fair pricing based on the underlying value of the fund's assets. 3. Redemptions and issuances. Open-end management companies are responsible for distributing shares to new investors and redeeming shares from those who want to cash out. This fluidity allows for continuous investment opportunities. How open-end management companies operate. Open-end management companies fall under the purview of the Investment Company Act of 1940, which regulates how investment companies must operate. They must comply with various regulations to protect investors, including Securities Act of 1933, governs the offering of securities to ensure transparency and accountability. Securities Exchange Act of 1934, sets requirements for reporting and financial disclosures. Investment strategies. Open-end management companies employ various investment strategies, allowing them to cater to a myriad of investor objectives. These strategies may include growth investing, focusing on companies expected to grow at an above-average rate compared to the market. Value investing, targeting undervalued stocks with the potential for price appreciation. Index tracking, mimicking market indices, such as the S&P 500, through index funds. Types of open-end funds. Open-end mutual funds. Open-end mutual funds do not trade on stock exchanges. Instead, they are bought and redeemed directly through the management company. Investors usually transact at the fund's NAV, making these funds an attractive option for many individuals. Diverse offering. Open-end mutual funds can encompass a range of asset classes, including stocks, bonds, and money market instruments. This diversity allows investors to align their portfolios with specific financial goals. Share classes. These funds often provide multiple share classes, which may carry different fee structures. Retail investors may have access to different fees than institutional shareholders, which highlights the fund's versatility. Exchange-traded funds, ETFs. ETFs are also managed by open-end management companies, yet they have distinct characteristics. Market trading. Unlike mutual funds, ETFs are traded on stock exchanges throughout the day at market prices. This means investors can buy and sell them like stocks and potentially take advantage of intraday price movements. Passive management. Most ETFs are passively managed, meaning they mirror the performance of a specific index rather than actively selecting stocks, resulting in lower expense ratios for investors. Investing in open-end funds. Investing in open-end funds can be straightforward. Most investors do so through brokers. Purchasing mutual funds. Investors can directly choose mutual funds through the management company or a financial advisor. Transactions occur based on the next computed NAV at the end of the trading day. Buying ETFs. Investors looking to purchase ETFs can do so through brokerage platforms, similar to buying stocks. This flexibility allows for quick transactions based on market conditions. Open-end versus closed-end funds. Understanding the differences between open-end and closed-end funds is vital for any investor. Share availability. Open-end funds continuously offer new shares, while closed-end funds have a fixed number determined at their IPO. Pricing mechanisms. Open-end funds are priced at their NAV once daily, while closed-end funds are traded at market prices that can differ from NAV throughout the trading day. Investment approach. Managers of closed-end funds believe that maintaining a fixed size is optimal for their investment strategy. Conversely, open-end funds can continuously grow as investor interest remains strong. Special mention, open-end index funds. Open-end index funds, a subset of open-end funds, specifically track a market index. They share features with ETFs but differ in that they are traded based on NAV and can only be bought or sold at the end of the day. Conclusion. Open-end management companies serve an essential function within the investment landscape, providing investors with a range of options to access diversified portfolios. By understanding the details of how these companies operate and the types of investment vehicles they offer, investors can make more informed choices that align with their financial objectives. Whether one opts for a traditional mutual fund or a more dynamic ETF, the flexibility and variety presented by open-end management companies can play a significant role in building an investment strategy tailored to individual needs.